Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, April 12th, 5:09 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video, the Disappointment Edition. If you're a bull. State of the market, we're in an uptrend. We've been excluding industrials, financials, and real estate. Not going to take this off until we see how the week closes. About pre-market today, I was certainly thinking we were going to take this off after we were looking at a nice gap up in the futures after the CPI report came out, but that nice gap up faded about 5 minutes into the session, and then we faded badly to red, had a decent bounce. 2 p.m., the Fed minutes came out. The market didn't seem to like them. The Fed minutes reflected that they were talking about a recession due to banking. Not that this is news to anybody, but we did fade into the close, and just a really disappointing day for the bulls. Check over here at the trend gauge. Not really a disappointing day for market leaders. This week, we've been down all 3 days, and only one of the 21 over 21 list has broken below the 21-day moving average. There's one stock sitting right on it. Wingstop is the only stock from the list that has broken down. Leaders still acting, they're going sideways on a relative strength basis. Some strength, some weakness. Really, the only play has been to buy weakness and sell strength. Nothing really taken off to the upside. There are a few exceptions, of course. There always are, but for the most part, leaders uh, in an uptrend, but more toward neutral as far as what we would expect from a normally leader-led bullish market. Short term, 21-day moving average, big three, big cap indexes, the S&P, the NASDAQ 100, and the Dow, still above there. Mid and small caps struggling. Medium term, same situation. The 3 big cap indexes above the 50-day moving average, mid and small struggling. Long-term 200-day moving average, I'm a broken record. We'll take a look at the charts here momentarily. What just happened today? As I said, CPI gap up, fades badly to close red. Here are the numbers. RG7, this is our 7 growth ETF composite, down 0.93%, led to the downside by ARK-K. S&P 500 gapped up 0.5%, was up as much as 0.9% shortly after the CPI report came out. So definitely a disappointing reaction here to the S&P 500, but it did hold that 4070-ish key support level. In fact, didn't quite touch it. NASDAQ 100 lagging again, down 0.9%. It gapped up 0.6%, was looking to be the strongest of the indexes, well, stronger than the S&P pre-market, but again, semiconductors started selling immediately after the bell rang, and those led to the downside today as they continue to, after having a strong start to the year, continue to have some mean regression. Dow Jones Industrial Average down 0.11, led for the day. Among the indexes, mid caps down a little more than 0.5%. Russell 2000 down 0.7. Global Diversified 60/40 down 0.09%. Foreign stocks acted better today. In fact, they finished positive. VXUS finished up 0.3%. And also on a PE basis, on a forward PE basis, European stocks are trading at 12 times earnings versus 18 times earnings for US stocks. And there's also a much lower tech component to the European indexes versus the US indexes, and tech has been what's been weakening this month. So that explains the global 60/40 outperformance. In-house GROTECTION down 0.46%. NVIDIA disappointment today. That really was the standout to the downside. We'll hit the tail of the tape in charts. I'm going to try to start something new. We'll see if it continues to work out, but I'm going to call Wednesday Weekly Chart Wednesday with a focus on weekly charts. William O'Neill primarily worked off of weekly charts, and I focus more on the dailies than I do the weeklies, no matter how hard I've tried to use the weeklies. But on Wednesday, we're going to try to focus on weekly charts to take a step back and see the bigger picture. Let's get into it. And we're going to start off with what we do here at Revere Active Management. Hey, we're looking at a weekly chart of the S&P 500, and the active management component of what we do means that we're looking at moving averages, we're gauging the five major indexes versus those moving averages, and we're looking at how leading stocks are acting. You can see this black line is the 200-day or the 40-week moving average. What I have on here is a 10-week, a 20-week, a 30-week, and a 40-week simple moving average. And very clear here that I've been saying this for a while in all the videos. When we really started to roll over was mid to late April, when we got back above the 40 week, failed at the 40 week, and that started the first, actually the big second leg down. Then again, we bounced up again, hit what? The 40-week moving average, started the third leg down. Then we bounced up again, got into the 200-day moving average, failed, but then got back above it and made a higher high, and then on the pullback made a higher low. So the definition of an uptrend, and if you look at the 40-week moving average, is higher highs and higher lows, but we need to make a higher high before we make a higher low, and that means getting above 41.95. If you look here on this weekly chart, we've been struggling to get above 41.35. But if you look at this chart after 3 strong weeks up off the bottom, all it is 2 very tight consolidation days. I've been focusing on consolidation in the day count uh, portion of the tail of the tape that I show it. And, it's pretty clear here too. We also had a 2-week consolidation when we got into the 41.95 before breaking down and breaking lower, but put in a bottom the week of 317, rallying off that, and now going sideways, waiting for the moving averages to catch up. As always, the indexes will revert to the mean. How much of a reversion they do depends on what sectors are leading, what leading stocks are acting well, and that trickles down to what market cap and whether value or growth is leading. So, when you have a banking liquidity crisis, banks are going to drag down the indexes that are banking related. So, this stepping back here and looking at the S&P 500, this really doesn't look like there's any damage done. Doesn't mean I'm not going to show dailies, but on a daily chart, just pulling back to the 80 EMA. And as long as, we focus on the 21 EMA, and we've been above it for like 13 sessions right now. So S&P 500 uh, acting just fine. And then again, this is a situation where the sector rotation in the S&P 500, it works to your benefit as we see money come out of tech but go into other sectors over the last 2 weeks. Now, here's the NASDAQ 100. You can see after relative strength most of the year, everything's going to revert to the mean. Relative weakness over the last 2 weeks in particular, and really for the month. This relative weakness has been led by semiconductors and to a smaller extent the FANG stocks. But again, if you look at a weekly chart on this, we've got 3 strong up weeks, and all we've done is pull back to the pivot being 313.68. We're at 313.04. It's very likely that we could pull back all the way to the 10-week or the 50-day moving average at 305, and no damage would be done to this chart. We're going to get stops hit in individual names along the way, but our index holdings, and we did sell QQQ yesterday into the close as a risk management option. That vacillated between being a good move and a bad move today, depending on which wave of the downtrend or uptrend we were in today. But it's below where we sold it for now. A lower risk entry point. We'll look to get back in it. But again, I'm keeping that 25 stock list, and as long as those stocks don't break down, the big cap sectors are going to hold up just fine. Um, I might start documenting that 25 stock list to see what's holding, what's breaking, what's contributing to the different indexes. And as of right now, this is on a weekly chart, a normal pullback on the Nasdaq 100. Let's go to the Dow Jones Industrial Average. You can see the relative weakness that we had here that started in January and really all year turning into relative strength over the last week and a half. And there's nothing wrong with this chart either. We undercut the black line, the 200-day moving average, in mid-March when we were lagging. The Nasdaq 100 and the Dow take turns leading. Usually when one leads, the other lags. When one lags, the other leads. And since the Nasdaq 100 has started lagging, you can see relative strength on the Dow. So now back above all its moving averages. The green line there is the 20-day. The moving averages aren't stacked perfectly the way you would like to see them, but that's the case with all of the indexes. But you had a strong move here to close the year. Went sideways for a while. That turned into relative weakness, and now reasserting itself as money comes out of tech and rotates with the recessionary data that's been coming out lately. Let's go to mid caps MDY. You can see the very strong relative weakness that happened at the same time that the banking liquidity crisis happened. That's the primarily responsible for that. Into the declining 10-week moving average here, and then finally small caps IWM. Uh, you know, really putting in a tight 6-week consolidation, but under all the moving averages, very similar to the way we're putting in a consolidation on the bigger cap averages, but above the key or the bigger indexes, but above the key moving averages. So um, we stopped going down at the rate that we were going down, but note the relative strength line still trending lower over the past couple of weeks. So small caps not able to really get out of their own way, and relative strength making a new low well ahead of where price was. Compare it to here, compare it to here, and compare it to here. So we're going to need those stocks to participate. We're going to need some clarity, and we're going to get clarity over the next month as companies start reporting their earnings, starting with a bunch of the big banks on Friday. By the end of or the first week in May or the end of April, 87% of the S&P 500 will have reported, and we'll have a good idea by then exactly how weak earnings are. But not only that, exactly how much of that weakness has been priced in as Wall Street continues to lower its estimates. And now we need to see what kind of financial engineering these companies can do. See if everybody's in cost-cutting mode with a looming recession. Did they cut them enough to maintain their earnings per share and their forward guidance? So there's going to be a lot of moving parts over the next month, uh, unless leading stocks start to outperform, which I strongly doubt until after they each individually report earnings. Our focus will be on the indexes, as it really has been over the last couple of weeks, with UPRO being our biggest position and holding up well relative to its moving averages. So let's go now to the VIX. And for these, I really need to go back to the daily chart on the VIX. You see the tight consolidation here. With weakness in the indexes, how can the VIX be this low? I hear a lot of people asking that. The VIX what the VIX is represents expected volatility in the indexes over the next 30 days. And although the indexes are pulling back, they're pulling back in a fairly tight manner. The average true range on the S&P continues to shrink as it puts in this handle. So it continues to trend below the 21-day moving average, but it is in this tight range. One possible play on a breakdown in the indexes would be to buy VXX or UVXY. If we break above the 21-day moving average here, and it corresponds with a strong break below the indexes, but those are just possibilities that I'm mentioning, not predicting anything whatsoever. So the VIX basically closing unchanged despite the red indexes. Let's go to the dollar. Dollar making Back testing its lows from last week, failed break above this declining 21-day moving average, failed to break above this oversold condition. So with the dollar staying weak, that means GLD, GDX, and SLV should have good days, and they did. GLD making a higher high, up 0.5%. GDX up a full percent, higher closing high, and SLV, the leader of the day, up 1.7%, breaking strongly above this tight 5-day consolidation that it put in. Let's flip to bonds. Bonds were in bifurcation mode today. TLT, the long term, finished at the high of the day, bounced off the 21-day moving average, closed, as I said, near the high of the day, but it was on a price action, the laggard on the day, meaning just the inverse for yields. The other bonds, here's the broad bond index, BND, positive on the day. Um, all of the other duration ETFs, that's IEF, IEI, SHY, SHB, those were all positive on the day, which means yields were pulling back on everything on all maturities below the long-term 30-year. So that's BND. Let's take a look at the yields here. Here's TNX, the 10-year, down 0.4%. TYX, yield up 0.9%. As I mentioned, TLT, uh, different from all of the other shorter duration bonds today. And Bitcoin, which had a nice breakout. We're going to go to the 60-minute chart for this. A nice gentle pullback, still holding above this pivot, or really right into it. It's around 1770 to 1790, the various highs of those days, but holding on to that pivot. So those are the major indexes. Let's go to the tail of the tape. Explain what we do here at Revere. Why do we do it? To avoid these. The last 13 bear markets all occur beneath that black line. That's the 200-day or the 40-week moving average on a weekly chart. And usually you peak about 12% above the 200-day. This most recent bear market that we had, we peaked about 10% above back in January of 2022. It's what happens when you break below there that separates the run-of-the-mill 20% corrections from the vicious 37, 50, 36, 50, 58, 35. Despite the inflation worries, we didn't hit severe bear market, which is we classify as 30% or more on here, but still a 27.5% haircut is not what you want to see if you're headed into retirement. And we strive to avoid these and then participate in the indexes and leaders when the market gets back into a healthy posture. So let's get, as I said, to the tail of the tape here. So you can pause it to read through the entire thing. Here's the CPI below average versus the expectation. This is for the headline. Core was in line with expectations. Then after the 2 o'clock Fed minutes, that's when the market started to fade. We're currently pricing in a 70% chance of a quarter point hike at the May 3rd FOMC meeting. I recalibrated the consolidation day count, and instead of a C8, it's actually a C6 if you exclude the 2 days that we made higher highs. So we've been consolidating sideways for 6 days, coiling for a move. Looked like we were going to break out this morning on the gap up, but we didn't. All we did is pull back, not quite to the bottom of the range, but close to it. So the day count is 13 days above the 80 EMA and the 21 EMA. That's getting a little bit long in the tooth. Certainly the pullback is warranted, and that's what we've been seeing the last, or well, for this week anyway. Stayed in range between this 4078 and 4200 level on the S&P, broke below this 31368, which was the pivot of the breakout on the NASDAQ 100. The 21 EMA, we're right above there on the NASDAQ 100 as that continues to lag. The only thing, the numbers weren't bad on the day. The only serious sectors that I could find up were XLI, industrials, and OIH, oil services. Shorter duration bond prices were up also, as I mentioned. TLT and the rest of the bond yields down along with the dollar. Semiconductors, jets, as American Airlines warned before the open. Banks weak. CKY, the tech sector's weak. Retail weak. And KWeb, Baba and Baidu have been talking about their AI offerings. Well, the Chinese Communist government said before they take any steps with those, they're going to review them for compliance with government policies. And on that, KWeb got smacked today. This is what we own in-house in our portfolio. No changes to the portfolio today. So basically our beta is in line with the S&P 500. Bottom line for the day, CPI gap up fades badly to a bearish outside reversal and tech lags. Let's quickly run through the 21 over 21 to wrap things up, and we're going to do it on a weekly chart basis. And to basically do what I said, let's zoom out and see if anything's broken. We shouldn't see it. What we should see is a bunch of bull flags being formed on these charts, which is very typical of what you see when something gets extended and then pulls back to the 21 EMA. But this is a little step back and take a look at a weekly chart view for the day. So let's go through this quickly. NVIDIA, ON after the big move up after earnings. Lulu, 2 tight weeks after the big move up on earnings. TLT, consolidating after last week's move. Rambus, 2 tight weeks after the big move out of the base. GLD, trying to move after you moved up, you had a 2-week consolidation and then higher highs on the weekly. That's a very bullish chart. TMDX breaking below the 50-day moving average now, but volume is lighter this week. QQQ, we already looked at this, and there's more than 21 in here. I add a couple of things to track, but it's the 2121 less than a couple of indexes, and TMDX because we own it. Nice pullback on QQQ. GE just extended. A very tight week for it. Palo Alto continues to just go sideways, but relative strength rolling over. This is something else you're seeing on the weekly chart on a lot of the tech-related names is a lack of relative strength. However, Lantheus, which is consistent with how medical stocks outperform in a recessionary environment, Lantheus making higher highs. Kind of choppy, but the chart looks fine on a weekly basis. Axon, same thing, inside week so far. 2-week pullback for GE Healthcare after the breakout. Tight consolidation for Meta continues to be strong. Pulling back Wingstop, this is one that broke below the 21, still above the 50-day moving average. That doesn't look like there's anything wrong with that either. PagerDuty inside week. CDNS, one tech stock that's not really pulling back much, continues to show strength, is CDNS. ELF continues to trudge higher after this bounce off the 50-day moving average 4 weeks ago. 2 tight weeks for mobile after the gap up after the oil production cut. GDX continues on its 5th week higher. Mondelez inside week after the move out. FedEx inside week also. SE, 2-week pullback once it reached the pivot plus 20% area. And that's it. That's your 21 over 21 weekly charts. Leave comments on YouTube or let us know if you like this approach for weekly chart Wednesday, or if you'd rather see a focus on daily charts. I'd be interested in your feedback, and you can give me that feedback at don@revereasset.com. You can also hit my partner, Dan Stewart, dan@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. And with that, reminder, it's not how much you make in the markets, it's how much you keep. And with that, I'll wrap up Wednesday, April 12th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.